Hey guys, Lance Martin, Coldwell Banker, Town and Country. We are here with our August market snapshot. It is crazy. We are in August of this year. Nuts. So I want to jump right in. Again, Lance Martin, this is my info. We've got our QR code on the next slide. This is the same QR code we've now been using for quite a bit. So this has all of our market snapshots on it and our market forecast that we did back in March and everything else that you ever might want to know from me or for what we're doing at Coldwell Banker, Town and Country. So as we jump in again, we've been starting with what's in the news. I don't have any news articles for you today, so I guess maybe I should say not what's in the news, but what's in the past. So we're going to go back and play some of our greatest hits. So what is in the news? Well, it's the inflation fight. We have been in this never-ending, what feels like a never-ending fight over inflation. And okay, well, great. When you do an inflation fight, there are consequences ahead, or as I have created a new slide called the unintended consequences. So last month I kind of developed a theme about, I think I told you that little story about what's unbelievable, and we used unbelievable to kind of describe almost every slide that we went through in the July snapshot. So I don't exactly know how I blend in the word unintended consequences all the time, but we appear, at least in my world, in the real estate world, to be in a world of unintended consequences based upon the inflation fight. And basically we're in a bubble, okay? And it's not necessarily the type of bubble that you might be thinking of, because most of the time when you use the word bubble in real estate, people automatically think inflated values, and bubbles lead to bad things, crashes, et cetera, et cetera. And that's not the type of bubble that I see that we're in, but we are definitely in a bubble. And what kind of bubble are we in? We are in what I'm referring to as it's a government policy bubble, okay? Which is really interesting because I'm going to tell a quick little story while I've got this slide up, and that's if you haven't catch the logo there, that's the logo for the U.S. Federal Reserve. And that is the government policy that I'm referring to. Let's just get off of this slide because this video is going to scroll and it's going to annoy me. So here's our Chairman Powell. We've had him up pretty much continuously for the last year and a half. And at various times I've put Chairman Powell photo up and I've said, hey, he's going to raise the Fed Reserve rate. Hey, he's done raising. Maybe he's going to pause. I don't know what he's going to do. Best I can tell, nobody knows what he's going to do. And I think in part because I've had this theory or this theme in my life, which I think I've been misguided, in that there are smart people doing smart decisions to guide whether it's our country or whether it's our economy or whatever it happens to be. And I've truly come to the conclusion that that's not the case. Not that they're not smart, or not that they're not trying to do the best thing they can, but at the end of the day, they do things that are intended to move a large economy. Well, I don't live in a large economy. I live in a small economy in Southern California, and maybe even a smaller economy in a part of Southern California. And I've come to know or realize that these gigantic policy moves might work at a macro level over a period of years, but there are unintended consequences that tend to happen either locally or, frankly, right now, I think nationally. So maybe the folks that are making some of these decisions quite aren't as smart as we thought they were, or at least maybe as I've given them credit to, whether it's a politician or whether it's, frankly, smart people in theory that are running the Federal Reserve. So I'm not going to go back a slide, but if I went back a slide and I showed you that government policy bubble, it's kind of cute because I actually own the domain www.governmentpolicybubble.com. I've owned that domain for almost 20 years. And I acquired that domain, I think it was 2006 or 7 or somewhere in that range. And I bought that domain because I was going to write a book, or I thought maybe someone else would write a book and they would want to use Government Policy Bubble as part of the title of their book. And back then, I thought they would write that book, or I would write that book based upon the government's response to the foreclosure and the financial crisis of 2006, 7, 8, 9. And that response was no foreclosures, loan modifications, We have to salvage the financial crisis, and in part we salvaged the real estate side of the financial crisis by putting all of these policies in place, which in theory are going to help the problem and move us out of the problem. In that case, let's just call it the foreclosure crisis or the subprime lending crisis. And let's move us out of that problem faster. And I truly believe, and maybe I'm naive, but I truly believe that the people that were making those decisions believe that if we put a foreclosure moratorium in place and we did a loan modification program in place and we basically stopped what they thought were bad things happening from the market, that we would recover faster and things would get back to normal. And at least in my world, that government policy that was put back in place in 2006, 7, 8, and let's just say 2009 prolonged the problem for years, and we might even say a decade. And frankly, we might even say we're still dealing with that problem today. So I bought governmentpolicybubble.com thinking, hey, maybe I'll do something with it, and then nobody wrote a book, and I didn't write a book, and nobody called me and said, hey, I want to give you $200,000 for your governmentpolicy.com domain. So I've just had it sitting on my GoDaddy account for years and years and years. And then I was thinking about today's forecast, and actually I've been thinking about this for months. And I said, wow, we are in a brand new government policy bubble. And it's just different than the other one. So I've dusted it off, and I've actually redirected. If anybody wants to go to governmentpolicybubble.com, it should redirect you to me and our market data, and we'll see what happens. So bringing that back to the chief architect of government policy when it comes to real estate and a lot of other things. So here we have Chairman Powell. Nobody knows what's going to happen. So this is part of, I shouldn't call this news. We're going to go back and play the greatest hits reel. This slide should look familiar to you if you follow my stuff. This is Chairman Powell's news conference on June 15th of 2022. Let's call that about 13, 14 months ago. And this was the slide that I pulled up, and this is the slide that I shared at my forecast. So this is the slide that we talked about. And the gist of it is, government policy from Chairman Powell himself was to reset the real estate market in a way that housing market settles in a new place and housing availability and credit availability are at an appropriate level. So that has been the written stated policy of the Fed for at least 14 months. And why would we be surprised that we are continuing to struggle with Fed policy? Because they're attempting to make some changes. Those changes, in theory, if this was the goal, and if this still is the goal, is to reset the real estate market. Well, in an effort to reset the real estate market, maybe some unintended consequences. There we go. There it is. It's the first time I've been able to throw it in there. So maybe there's been a few unintended consequences of that policy. And by the way, what is the policy? The policy is the rapid acceleration of the Fed funds rate, which impacts all sorts of lending, but in our little world, the mortgage rates. And what are the unintended consequences of going from a sub 3% interest rate to a sub 6 and north of 6, north of 7% interest rate? Well, this is what we've been talking about here for the last couple of years. So here we are. Let's take a look at Los Angeles. I'm going to stop the setup. If you're just joining me now and you're feel like you're missing something, God, it seems like Lance skipped ahead, then you're just going to need to go back and watch some prior months' forecasts, watch the first 4 or 5 minutes of those, and then you'll get up to speed. For those of you that have been watching this for a while, I don't want to repeat myself every single month. So this is LA County. This is the start of the government policy. Extremely high, well, I don't want to say extremely high. Let's just call it all-time high median prices. And the thought was, hey, we're accelerating, we're coming out of COVID, we need to slow this economy down, we have too much inflation. And by the way, when it comes to real estate prices, we don't call real estate prices inflation, we call them appreciation because it's an asset and we love appreciation of our assets. We just love, or we don't like, inflation of other things. But at any rate, whether you want to call this inflated real estate property values or whether you want to call it a high appreciation property values, too much, too fast, which by the way, that's true. 20% appreciation year over year, that's tough. So the policy is, let's raise the interest rates. What do? We bring the prices down. People are panicking a little bit. People are claiming crashes a little bit. And maybe that would have been true except for the unintended consequences of the policy, which everybody knows. We've been taught. We actually, I don't want to say we were the first people to talk about it regularly, but I think we certainly were in the beginning of the conversation that, well, when you have homeowners that have interest rates at 3 and 4%, their motivation to sell is diminished. Now, anybody who's talking about this sort of stuff always talks about the transaction problem and the inventory problem, and they always tie it back to which is the truth, is you have inventory locked in place because people have low mortgages locked in place, and their incentive to get out of that mortgage is zero. I'm not going to get out of my low mortgage and trade it for something that's double. I'm just not going to do it. So again, the unintended consequences of raising these rates, I truly believe nobody thought far enough ahead at the Fed level or at the policymaking level to think, oh my gosh, what if we go from a 3 to 7% interest rate over a period of 12, 13, 14 months? What is that going to do? And I think what they thought it was going to do, I think they thought it was going to kind of do this: reset property values, bring them down, intentionally cause a pullback, a crash in residential real estate values, reset the market, make it more affordable, bring this from an appreciation market to a deflationary market or a depreciation market. But I don't think they thought it through. And I don't think that they thought through the fact that that's going to lock in inventory. There's not going to be as many houses to sell. A certain group of people are still going to need to buy, and therefore a supply and demand market. So if we still have a free market in any way, shape, or form, the supply and demand of the free market is then going to, in effect, kick in and prevent any continued softness in the property values, and that is exactly what happened. So if you've been watching my stuff and we go back into this area and everyone's freaking out and I'm like, I don't know, I don't feel it, I didn't feel it then, and I certainly don't feel it now. Why? Because I don't care what interest rates are. When you have this many houses for sale and at least this many or more people that want to buy, you're going to see values level off, and you're going to see values increase. And not that I'm the smartest guy in the room, because I'm not, but this was fairly predictable when one thing became apparent. And the one thing that became apparent was, nope, these people aren't selling their houses. And when that was obvious, that we were not going to see the inventory hit the marketplace, it then became pretty obvious to me that we're not going to see a collapse or any significant drop in value. And quite honestly, we're going to start to see a rise in value. And for those of you guys on the foreclosure mindset and the crash mindset, keep in mind that government policy that I just talked about a minute ago that goes back to 2007, 8, and 9, that's basically still in place. Banks do not want to foreclose on people who are behind on their mortgage, and they do everything they possibly can not to. That's just the way it is. That policy is still in place. But this is the other thought. If I'm in trouble as a homeowner, and I'm truly in trouble, okay, I've lost my job and I'm just a mess, but then I take a look at the home I'm in, I take a look at the interest rate I'm paying, I take a look at the mortgage payment I'm paying, and I turn to my wife and say, hey honey, this is rough. Sorry, but we got to abandon ship here and let this house go to foreclosure, and then we're going to go rent something for a little while. And then we take a look at the rental market and we say, you know what, I think we're going to stay right here. Whatever we got to do, let's do what we got to do to stay right here in this house, even though times are tough. And I believe those homeowners who even do have difficult times will do everything they can to get that mortgage payment paid, stay out of a foreclosure situation, and because they don't want to go pay what would have been maybe double the rent that they were expecting. So just one of a million factors. So let's get back to our chart. LA County, this is peak. This is where we were at trough. This is where we are now. LA County, median price up again month over month. We'll get to the numbers here in a minute. Here is the 12-month LA County year over year, July to July. Does that look like it's kind of actually gone down and come back up? Well, it has. And not only has it, if you go year over year, July to the July, LA County, median values up. All of this has basically been erased, which is what we've been talking about for months now. This is peak to now. LA County peak was April of 2022. This is now, it's down a little bit. It's 3.7%. I'm skipping ahead. Adam's shooting the video. Today is August 6th. It's a Sunday afternoon. Hopefully we'll get this out later today or tomorrow. Before we shot, Adam, what did you say, Adam? I just lost my total train of thought. Adam said something, which I just forgot, but the bottom line is, he was saying where we are with values. Now I remember. Don't cut that out, by the way. Where are we at with values? I said, 3% up, 3% down. Material doesn't matter. This is 3.7% down. If it was 3.7% up, I wouldn't feel any differently. Now, when we get these 10, 20, 30% swings, okay, well, that's something to pay attention to. But a 3% here, a 3% there, who cares? It's up or down. But what is important is the trend. And the trend, which, by the way, this is the next slide. This is our year-to-date trend. By the way, I have another opportunity to say unintended consequences. The policies, I can assure you, the Fed did not intend for values to kind of slow down here a little bit and then go up for the last 6 months of 2023. As a matter of fact, when they see that, they probably don't like it, which means we will probably have more policy, which potentially could be even higher interest rates, which create even a bigger problem. Because even higher interest rates do, if anything, they keep that current inventory locked in place even longer. If I've got a 3% mortgage on my house right now and I don't want to sell because I'd have to replace it with a 6.5% or 7% mortgage rate, what do you think I'm going to do if I own a property and rates are now 7.5 or 8? I'm going to be locked in even harder. And this is, again, a result of a government policy, in my opinion, that's just screwed shit up. I mean, there's just no way to put it. Now, for those who are like, hey, Lance, we have inflation and it's bigger than real estate. We got to combat inflation. Okay, I got all of that. But government policy, by the way, which kept interest rates artificially low for all this period of time and then just crammed them up, maybe cramming up isn't the right word to use, but then rose them or inflated the interest rate up over a period of 14, 15 months, well, that's not smart policy either. So at any rate, this is LA County year to date. That is an 11% increase in median single family homes in LA County from January to July. 11.4%. If you own that house, you're ecstatic. If you're looking at the overall market, not so much, because that unintended consequence is ultimately a problem for the marketplace. So LA County, $880,000 median, 12-month, July to July, up 1.7%. Last year it was $865. 2 years ago it was $839. By the way, the 2-year number for LA County, it's only 4.8% increase. Why? Well, because we had that trough and now we've come back. Peak to current, minus 3.7, but there's that 11.4% year-to-date number for LA County. It's just absolutely phenomenal, I guess. Phenomenal. Unbelievable. I'm going to bring it back from last month. Inventory problems. LA County, still no change. I mean, inventory, the trend is still down. I think last month I said maybe, just maybe, we'll see a little bit of inventory uptick in the counties. Nope. Either flat or down. So, these seasonal adjustments that we've seen with inventory rising, I don't know. Are we going to see a seasonal decrease? Because if we stick with our seasonal real estate numbers, inventory should continue actually to fall off, which means the numbers get even worse, which means the supply gets even smaller, which basically means that you got a smaller supply, same number of buyers. Maybe we lose some buyers, but if we lose some buyers at a higher interest rate, but we still have fewer homes to choose from, what does that do to prices? It just keeps these prices stable or even higher. So there's LA County supply and demand. This is the absorption rate for LA County. It's just, there's nothing for sale. That's what we're saying here. 9,500 houses were on the market in LA County. It's a 30% fewer homes than a year ago, 26% than 2 years ago. Only 2,300 homes went into escrow in the entire county in the month of July. 8.1% fewer than 12 months ago. 12 months ago was not great, guys. Go back and watch my July 2022 forecast. I was already starting to give you this tone of anxiety. They said, oh my gosh, the market's shifting. What does this mean? Okay, well, here we are. The numbers weren't great, so here we are a year later below that number, and then 36% below the open escrows pending transactions from 2 years ago. So what is Riverside County? Riverside County, again, we're doing LA, Riverside, San Bernardino, Orange, and I've got my Spotlight City. Riverside County is the only report I'm going to show you that actually shows a ever so small, but nevertheless, a pullback in median. So we got a small little pullback in median price from June to July. We'll see what happens with that next month. Does that wash itself out? For you median price people, now's your chance to say, oh, you're using the wrong numbers. You shouldn't be using median. Again, go back and watch my prior videos. Median's fine. Long-term projection is fine. But Riverside County pulled back. It's the only one that pulled back, and it did surprise me a little bit. I was not expecting that, so maybe that'll level itself off next month. We'll see. Here's the 12-month chart for Riverside County. Very similar to LA with the exception of that pullback last month. Peak to current. There's our peak, April, and our current, that's 4.5% down, 4.5% down, peak to current. So again, last LA County, I said 3.5%, no big deal. 3.5 up, 3.5 down, I don't care. 4.5% down median from peak. Okay, fine, it's 4.5% down. I'm perfectly fine with that. Certainly don't see any reason to panic one way or the other. But again, here is our year-to-date Riverside County. That's a 5.8% increase. It would have been higher, but we pulled back. Keep in mind, a 5% increase, if you annualize that for Riverside County for the next 6 months, it's going to put us at almost a 12% increase. Again, we cannot continue to have these double-digit price increases year over year, but we're on track to do that. And by the way, if you look at LA County, we're on track to do a 20% annualized real estate increase or value increase in LA County, which I don't believe is going to happen, by the way, but the numbers are ridiculous. You know what they are? The numbers are reflecting unintended consequences. There you go. I didn't think I was going to be able to work that in, but here we go. So here's median in LA County, 587. From a year ago, flat. 0.5% down. That was 590. 550 2 years ago, 6%. Peak to current, that's the one I just told you, 4.5% down. Year to date, 5.8%. Again, the supply inventories, it looks the same as LA County. We did not see any change at all. If anything, just flat with the red bar. That's your inventory. There's our trend bar. Whew, that is an ugly trend bar. So there's 12 months Riverside County of inventory and pendings. There's our month supply trending down. Again, we spend very little time looking at this chart. Half the time I pull it up, I just blow right past it. I'll take 15 seconds and give it a little bit more love since it's on here. Month supply of inventory. If you look at this chart alone and nothing else, this can certainly be a predictor of future prices. When these numbers go up, in theory, there's going to be more inventory. There's going to be pressure on values either to stay the same or maybe even pull back a little bit. As these numbers go down or these bar charts go down, less inventory. So unless the buyer demand completely disappears, that almost is there you go. That's the easiest chart to say where our value is going to go. Well, we'll see. And by the way, if buyer demand goes down, this doesn't go down. They don't go that way. Okay? It just doesn't work that way. Matter of fact, maybe a better way for me to put it, don't look at this chart as open listings or available listings, which is what this is actually. This is the absorption rate of how many, let me take a moment here. That's 1.7 months. What this says, if no other houses came on the market, not one person listed their house, with the existing supply of buyers on the market in 1.7 months, let's just call it 6 weeks, every single house is sold. There's nothing else to buy. That's what this says, okay? However, let's spin it around, okay? What percentage, what's the buyer pool out there, okay? So when this number goes down, all that says is there's not enough houses to satisfy the buyer pool. So there's still buyers out there, even at a 7.5% interest rate. Oops, did I say 7.5% interest rate? I did. I skipped ahead, but the unintended consequences of where we are you are today looking at more than likely a 7.5% 30-year fixed mortgage on a conforming conventional loan. Ouch. Okay, so here's homes for sale in Riverside County. Doesn't matter what these numbers are. 37% down from a year ago, 18% down from 2 years ago, 6.5% fewer home sales than 12 months ago, and 30% fewer home sales than 2 years ago. So there you go. What's San Bernardino County doing? San Bernardino County looks more like LA. We picked up a little bit of price over the 2-year or the 24-month window. There's our trend bar, basically flat. year over year, July, San Bernardino County, that's a 1% decrease, flat, nothing, meaningless. It's flat. The value is no different than it was 12 months ago. Here's our peak to current. Peak was April, there's current, down 2.9%. Again, meaningless. It's flat. We've wiped out any sort of price reductions, destruction. Chris Thornberg laughed at me when I used price destruction. It's all gone. We're basically back at our current trend. If it doesn't happen next month, it's going to happen soon. All of that will be gone, and we will see positive numbers again. Similar to LA County, San Bernardino County, almost 10% year to date. January to July price appreciation, 9.7%. Unintended consequences, bad policy. I don't know. Someone explain to me what we could have done differently. I don't know. Medium 510, again, flat over 12 months. 2 years ago, up 8%. That's the number I just gave you, down 2.9 from current and up almost 10% year to date. Supply and demand looks identical to Riverside, San Bernardino. Red bars, that's really all we're focusing on. There's your trend. We have no listings. Broken record over again. Same chart we just looked at. Does it look identical to Riverside? It's similar. This is San Bernardino, but it's, supply is down. Shocking, shocking, shocking. So what are we looking at again? Don't pay any attention to this. 32% down from 12 months ago, 22% down from 24 months ago. In the last 12 months, flat. Basically no change. These are sales. But down 39%. So if you wanted a silver, hey Lance, do you have anything that's kind of exciting that might be a positive trend as far as San Bernardino? And again, not good news, not bad news. I'm just giving you what it is. It's painful if you're a real estate professional looking to do transactions. But this number is probably the most pleasing, optimistic number I have. Why? Because this is pending sales in San Bernardino County 12 months ago. So let's go back. Let's go back a chart. Caught myself off guard. Blue bar, not red bar, blue bar. 12 months ago, blue bar now. We've seen a dip, but we're basically in the same place, pending sales. So that means one of two things. Either we've kind of stabilized year over year, or it basically means that July of 2022 was awful. Guess what? July of 2022 was awful, okay? So, but at least we didn't get more awful. So there you go. So there's your San Bernardino County supply and demand numbers. Let's jump ahead to Orange County. I've kind of brought Orange County back because I heard all sorts of horrible things were happening in Orange County. I said, hell, you're still in our market. Let's take a look at it. Well, I don't know what's horrible happening in Orange County. The median price in Orange County is $1.275 million in the county. There's your 12-month chart. There's your, that was your 24-month chart. Here is your 12-month chart. Unlike the other counties, which are down a little bit, the 12-month chart in Orange County is up. That's that trend bar, 5.7% increase. So, let me pour some salt in a few wounds out there because I know people in Orange County, we talk about this period, I'm not going to buy, prices are too much, there's no affordability, we're going to collapse. All of those people were telling me this here, okay? I'm like, hey man, I don't know what to tell you, man. If that's where you want to live and that's where you need to be and that's where your family is and if you can afford it, and you can get it over, which by the way, over here, you would have been at a 4.5, maybe a 5% interest rate. I ain't doing that. I saw some Yahoo on Facebook or Instagram say, get out now while the getting's good. Well, anyway, they were right, and they were right until they weren't right, because the unintended consequences also apply to Orange County just as much as they apply to San Bernardino County. Two completely different markets, basically following the same policy and the same trend. There are some differences, but there's more similarities than the differences. So this is peak to current. It's still down a little bit. That's a 1.9% decrease from peak to current. So if you did buy here and you regretted it, well, okay, you've lost 1.9% of your investment if you're basing it on the median. That's nothing. Sit back, relax. And here's our year-to-date numbers. 10.4% in Orange County. 10.4%. Pretty impressive numbers. That's $1.275 million. Now, for those of you who are like, I know that market and that number is insane and it's overpriced and it's too hot, I don't disagree with that. But that doesn't change. My parents said that. I can remember growing up in Lakewood and you're never going to be able to afford a house and that's going to cost $30,000 and $100,000 and $200,000. Yeah, okay, yeah. Well, we say the same things. So these are the numbers. It's 5% increase from 12 months ago, down from peak, but up 10% year to date. So Orange County, other than you have an inventory problem, which is right here, values are just fine. Same thing with the red bars. We did see a little bit of increase in inventory, but the trend, brutal, brutal, brutal. Month supply, Orange County. Here's the numbers. These are the sales numbers. The listings are down 37% from a year ago, 31% from 2 years ago. These are the pendings. 4.5% from 12 months ago, 40%, 40% pending sales, open escrows, buyers and sellers coming together, 40% fewer than 2 years ago in Orange County. Okay, I was with Drake yesterday. He said, hey, buddy, why don't you participate in our snapshot? What city do we want to do? We went through a couple things and somehow we landed on Anaheim, so Anaheim it is. So our monthly snapshot for city of Anaheim, which is basically eastern Orange County, I guess, just kind of like on that border. You're not Inland Empire, but you don't live in Newport Beach either, sorry. But you're still Orange County. Guess what? A little bit of a pullback, which is interesting because that's what we saw in Riverside County. A little bit of a pullback month over month. This is the 12-month chart, flat by the way, flat. City of Anaheim, from a year ago to a year to today, completely flat. That's a positive 0.2%, just to skip ahead. Peak to current, down 3.5%. Look familiar? Sure does. Where are we year to date? Year to date, up 6.2%. Kind of like right in that range. So these are the numbers. Median in Anaheim is 850, flat for over 12 months, up 12.5% from 2 years ago. Peak to current, still got a little bit of room to make up, but up year to date. So Anaheim is doing its thing. Small data sample, by the way, but guess what? The trend is down. Now, interestingly, this is why all real estate's local. So if you're watching your stuff and you're like, Lance, you're kind of talking, you're kind of talking globally. I live in this little community in this particular city in this zip code, and I have an HOA, and my house is beautiful. You may not fall into this bucket. It's entirely possible that your numbers are way different, all right? Which, by the way, we sell real estate. Okay, Lance Martin, Drew Martin, Drake Martin, Coldwell Banker Town & Country, the Martin Group, and our agents that support us as well. So if that's the case, let us know. Let us sit back and give you some numbers that are accurate to yours. The reason I mentioned that, I got a little surprised. I hadn't pulled Anaheim numbers. Well, Anaheim actually saw a little bit of a pickup in listing inventory going back into May. And frankly, you can kind of saw that happening in April and May. If I had seen this as a trend in Anaheim, I might have said, hey, guess what? Things look pretty good here in Anaheim. Maybe that applies to everywhere else. So you got to do a little deeper dive. But at any rate, they had that little uptick, and then the last 2 months, the inventory has basically tracked with everywhere else. And again, pretty dramatic trend bars. So if you just look at that red trend bar going down, so even though Anaheim had a little bit of hope over here, looked like it might break out and do something different. Well, no, it just fell in line with everybody else. And again, looks almost identical, the month supply. Now, very small sample, very, very small sample. So again, if you live in Anaheim, all we're looking at here is we're comparing 164 houses in the entire city. Okay, there was only 82 houses in the city of Anaheim that actually went into escrow last month. So the median home price guys that are like to slap me, this is the time to slap me. Median value on a small data sample is problematic. So if you have a home in Anaheim and you're thinking about buying or selling or doing something like that, do not use this data to make that decision. This is just it's a snapshot, right? Let's take a look at it. We need to do a much deeper dive because these data samples are too small. Anyway, nevertheless, volume down 40%, 30%, and sales volume actually up. Sales volume in Anaheim up year over year, 6.5%, but down over the last 2 years, almost 25%. So same slide. I think last month I said I need to get a little different slide to kind of send the message out, but this is the theme, and this is the theme that I have been beating into my agent's head and people that are listening to me is we just have a transaction problem. So if you're a seller, this is good news for you. Hey, fewer competition, you should be happy. If you're a owner of property and you just like to look at the value of your home, this is good news to you. If you're a buyer, it just means frustration for low inventory levels and interest rate levels. And if you're a real estate professional, which I'll define as a real estate broker, an agent, mortgage, title, escrow, Again, broken record. It's just tough, guys. It's tough. So we're just continuing to do what we do. Where are we with interest rates? By the unintended consequences. So this is optimal blue. This is a 12-month chart, 30-year conforming conventional loan with a 20% down payment with a FICO of around 750. So if that's you, if it's not you, then you can just disregard everything I'm going to say because it all changes day to day. This was as of Friday, December 4th, or August 4th. Friday, today is August 6th on Sunday, so wake up tomorrow morning, it's going to be different. But here's a year ago. We were basically below 5.5% last August. We kind of, in November, we hit above 7. We've been tinkering around. We started to see some improvement. This is where I started to get excited back in February and March. I think interest rates are coming down a little bit. Market seems to be improving a little bit. Maybe we're going to kind of come out of this and we're going to have a more normal market, whatever that is. Well, then my hopes and dreams were faded and dashed, and we went up, and we've been tinkering around, and now the last, month or so has just been brutal. So this is optimal blue. This chart is available to you guys. You can go search optimal blue mortgage indices. You'll have the same exact data I have. It's public. Or if that's too much to remember, just go to the QR code, find my stuff. It's just there. You can click on it. It takes you to this chart. It's always about 24 hours behind. But this is optimal blue. It averages kind of the world, if you will, when it comes to mortgage rates. This is Google. This is what 99% of the consumers are going to do. They're going to go in. I did this morning, but this was as of Friday. Same thing, $500,000 loan. If you're getting a higher loan, raise the number. But 500, 20% down, 550, 4 point, basically 4 point. Good Lord, 7.5% mortgage rate. 7.5% mortgage rate. Now, is that an unintended consequence? Maybe not. Maybe that was the intention. Maybe the intention was to drive interest rates from 3 to 7.5, and we're going to slow everything down. But I think what they thought might have happened is that would slow everything down and prices would pull back. Not that 7.5% interest rates would actually increase prices. You know what? There's a lot of smart people out there, Bruce Norris and many others, that if they were advising the Fed, they could have predicted this, okay? So, but anyway, that's what you're looking at right now. For most consumers out there, you're looking at certainly looking at a mortgage rate above 7.5%. If you're getting a quote 7.5 or north of 7.5, it's probably where you're going to be right now. So we'll see. We'll see what happens here over the next little bit here. So that is my August 2023 real estate market snapshot. Thank you guys for watching. Share my stuff. Comment on my stuff. All of the charts and graphs are available. Just kind of follow the link, go back and find the QR code. Lance, you didn't post the link. You say you post the link. Go back, watch the video, get the QR code. Everything is there. Anyway, have a wonderful remainder of your summer, and we'll see you in September.